Hello and welcome. We're now going to discuss financial statement analysis. Financial statement analysis is a key skill if you want to actually use the financial statements for decision-making purposes. Financial statements are read by a whole range of different business stakeholders, from managers, investors, lenders, and so on. But financial statements are only really useful when we actually conduct analysis of them. In these videos, we're going to discuss different ways of analyzing financial statements, starting with horizontal and vertical analysis and moving on to various types of ratio analysis. By conducting this analysis, you'll be able to tell a story about the business and understand what's actually happening behind the numbers. So let's get started with the basics of financial statement analysis. The main purpose of financial statement analysis is to help you evaluate the performance and position of a business. So if I told you my business made a profit of $1 million and asked you to evaluate the performance, asked you to consider investing in my business or lend it money, how would you go about evaluating if that was a good business performance? Well, you'd have to start by asking for a lot more information. How long did it take me to make that $1 million of profit? How much money did I have to invest to earn it? What was my asset base, my equity base? There are a whole range of different things that you need to know before you can analyze if $1 million profit was good in this particular situation. Let's have a look at the different tools that you may utilize to evaluate this. The most common tools you'll use in financial statement analysis are horizontal analysis. Horizontal analysis simply involves comparing a business's performance in the current year to the prior year. You're going to look at how different accounts on the balance sheet, income statement, or cash flow statement have changed over time. As we introduce more and more years, we'll call this trend analysis rather than just horizontal analysis. Next up, you may look at vertical analysis. Vertical analysis allows you to compare financial balances to a base account for different financial statements, and it's a great way of being able to compare businesses that are different sizes. And finally, ratio analysis. There's a whole suite of different ratios we're going to look at, and depending on the purpose of your financial analysis, whether you're an investor or a lender, a manager or a competitor, there's different ratios that you'll be interested in that will tell you about different parts of the business's performance. So financial statement analysis generally involves three main parts. First of all, we have to calculate something. We have to conduct our calculations. Now, I want you to learn how to do the calculations, and I'm going to show you how to do a range of different calculations. But computers can do most of the calculations for us. There's a range of different databases that contain all sorts of financial information, and a lot of these ratios and analysis are already conducted for you. So the next step, understanding the numbers, is much more important, and that's where we'll focus our learning on. Understanding what the numbers are telling you about the business, and then taking the next step and being able to actually tell a story about the business are the key skills to financial statement analysis. The storytelling side is the more interesting part of the analysis, and it's the more valuable part of the analysis where you can actually gain insights from the numbers and understand what's going on in a business situation. So to be able to conduct a good financial statement analysis, you need to know which tools are right for the job. And the first thing that means is you need to know what is your overall objective. If you're working for a bank and trying to evaluate the creditworthiness of a business, the ratios and tools you use will be very different to if you're an investor. So you need to know, what is your purpose of financial statement analysis? What are you trying to learn about a business? Once you know what you're trying to learn, you can then apply the right tools for the job. There's a whole suite of different ratios, and the ones that are going to be more important or more useful to you will depend on if you're looking at the profitability of a firm for investment purposes, if you're looking at the liquidity of a firm because you're a customer or a supplier and you're interested in their ability to maintain as a going concern, or the capital structure if you're a bank and worried about the riskiness of the business. One of the difficult parts of ratio analysis is that ratios very rarely provide much information on their own in isolation. When interpreting ratios, you'll often have to look for more information. So let's say we calculate a profitability ratio. What does it tell us about the firm? Well, on its own, likely nothing. The first thing we'll generally do, we'll compare the performance of the firm this year to how it went in prior time periods. Another way of evaluating a ratio is by looking at your firm's performance compared to competitors in the same industry or industry benchmarks. We want to know, is our firm doing better or worse than others in the industry? And in some rare cases, there are absolute benchmarks. This will often happen when there's a regulator involved. Banks have to maintain certain equity ratios. Sometimes banks will ensure that who they lend money to have to maintain certain ratios. So sometimes we'll have absolute benchmarks for our ratios that we have to say the number has to be above X. However, most of the time when we interpret ratios, it's more of an art than a science. We have to think about how does our firm compare to others in the industry or how it's gone in the past, and understand the reasons why the ratios may be changing over time. The most important thing when you're doing ratio analysis, the ratio should provide you more knowledge about the firm, and you should use those numbers that you calculate to then gain a better understanding of the underlying business factors. You need to be able to understand why the numbers are changing, why the numbers are how they are, what's actually going on in the real business that leads to the creation of these ratios and figures that you're seeing. So ratio analysis should aid you in your understanding of the business, their business model, their opportunities, strengths, and weaknesses of the firm.